Financial Modeling, Topic 18, Forecasting Financial Statements and Free Cash Flows, and using at-risk, non-normal distributions. References include Financial Modeling, 4th edition, Chapter 5, Pro Forma Financial Statement Modeling. Our topics include, we're going to forecast financial statements, we're going to evaluate external funds needed, also called EFN, and capital structure decisions, assess growth and EFN, understand and forecast free cash flows, and use non-normal distributions in at-risk. So topic 1, we're going to forecast some financial statements. Now, financial statement forecasting is an integral part of the strategic planning process to ensure a company meets revenue, profit, and EPS, that's earnings per share targets, ensures investments in CapEx and working capital are consistent with your revenue and profit targets, ensures you secure the right amount of debt and equity financing for your CapEx and working capital, determine optimal capital structure, that is the mix of debt and equity financing, and ensures cash flow distributions to shareholders are consistent with investment needs, optimal capital structure, and shareholder preferences. And forecasted financial statements are also called pro forma financial statements, so in case you've heard that term. So the ingredients to forecast my financial statements, my income statement and balance sheet, I'm going to first start off at the top of the income statement, also called the top line. So we're going to get a sales growth, say if we're looking at a 5 or 10 or 15% sales growth, what you'll start with would be inflation estimates, any market growth in your industry, any growth in your market share within your industry, and where you are as far as production capacity. Can you even produce enough goods? And then you move on to OPEX, or operating costs. You'll look at your cost of goods sold, which generally grow with sales, or maybe some percentage of sales. SG&A, selling, general, and administrative expense, and the same as cost of goods sold, that usually grows with sales, or you just specify it's some percentage of sales. Depreciation, well, that depends on our fixed asset balances and any new CapEx. We'll look at our interest expense, which will be based on balances and interest rates. For taxes, we'll usually just use the corporation's average effective tax rate. Working capital, or those short-term assets and liabilities, often grow with sales. Fixed assets, well, that depends on the production capacity and sales growth. If you're not growing sales, maybe you just have enough fixed assets to replace the assets that are aging. However, if you're at capacity, you might need to build a new factory or a new warehouse. In that case, your fixed asset growth might be greater than sales. At the bottom of your balance sheet, you're going to look at retained earnings, which are going to be the prior levels retained earnings plus additions to retained earnings, which is the link to the income statement, which will be additions and retained earnings are going to be your net income that are not paid out as dividends. And then you're going to have your debt and stock your changes, so your financing decisions. When we're going to forecast the financial statements, what we're going to do is a number of passes. Our first pass, second pass, and third pass for our pro forma financial statement. So what are you going to do in your first pass? You're going to forecast your net income and balance sheet balances with no adjustments to long-term financing. In other words, don't mess around with debt and stock yet. And what you're going to do is you're going to then, what's going to happen is your balance sheet is not going to balance. So assets are not going to be equal to liabilities and equity. So you're going to calculate your external funds needed. So based on your forecast of income and assets and working capital and those things, you're going to then know what the difference between your assets and liability and equity is. And that's going to be your EFN, your external funds needed. Your second pass is when you deal with the second part. The external funds needed. On your second pass, you then evaluate that external funds needed and say you need another $100 to finance your asset growth. Well, you need to make some assumptions. Am I going to raise debt? Am I going to raise equity or issue debt or issue equity? Or maybe I can just use some of the cash balances. So EFN, or the second pass, you're dealing with your external funds needed. Your third pass has to do with the feedback related to the second pass. And what it relates to is in the second pass, if you issue more debt or change any cash assumptions, in which cash which generates some interest income, those changes are then going to have a feedback effect back onto the income statement. So for example, you do your first pass and you determine that you need $100 more of external funds. Then you issue $100 more of debt. That's going to generate $100 more of interest which is then going to reduce my net income. So where you're going to find that's going to have an effect on retained earnings, and then the balance sheet's not going to be in balance again. So the third pass is you're dealing with the effects of interest income and debt interest expense, and making sure the balance sheet balances. So let's take a look at this first pass on a financial statement. We're going to make a bunch of assumptions. We're going to assume that we have 2019 actual expenses, and we're going to forecast 2020. We're going to assume that sales grow at 20%. Cost of goods sold is going to be 40% of whatever sales level is forecasted. SG&A is going to be 20% of sales. Depreciation, we're going to assume this 23% as an expense of net fixed assets. So it's going to be 23% of my net fixed asset value calculated down here. We're going to assume we pay 8% on interest on debt and earn 2% on my cash balance. We're going to assume that on working capital, all my short-term assets and liabilities, excluding debt, will just have them grow at the same rate of sales. So I just specified the same rate of sales. We're going to assume the net fixed assets I need is going to be a percentage of sales. So just for simplicity, we just say that you have fixed assets equal to 100% of sales. So if I need $1,000 of sales, I need $1,000 of fixed assets. All right, and that's just a simplifying assumption. And then for our first pass, we're going to assume no change in bank loan, no change in debt, no change in common stock. And then as far as our dividend payout policy, we're going to pay out 25% of our net income as a dividend. The remaining 75% is plowed back into the firm, which goes into retained earnings, which is a source of financing for our assets. So let's go ahead and forecast our financial statements. I'll switch over to the Excel sheet. And I'll start with my top line. I'm going to assume that sales grow by 20%. So I'm going to take the prior year's sales times 1 plus my growth rate. In this case, instead of assuming that my operating costs, cost of goods sold and SG&A, increase at 20%, I'll just specify it a different way. I'll just say that cost of goods sold is going to remain at 40% of my sales forecast. So I'll just take 40% of my $1,200 forecast of sales. And for cost of SG&A, I'll take 20% of my sales forecast. I've already put in my formula for depreciation as 23% of net fixed assets. That's down here. And now I can get my EBIT. My EBIT will be my sales minus my cost of goods sold minus my SG&A minus my depreciation. So there I have my EBIT. Now, interest expense, this isn't working yet because I need to work a little bit on the balance sheet before I can go any further. So we're going to make an assumption that short-term assets and liabilities grow at 20%, which is the same assumption for sales. So that's a common thing to do. So I'm going to have cash times 1 plus this new growth rate right here. I'm going to anchor that growth rate. And I'm going to copy that formula for receivables, inventory, other current assets. I'm going to also copy that formula for accounts payable. So now I have my current assets growing at 20%, just like sales. In this forecast, I'm not forecasting my fixed asset cost and my accumulated depreciation. It's common just to forecast the net. So normally net fixed assets will be fixed assets at cost minus accumulated depreciation. But I'm just going to forecast the net fixed assets, and I'm going to have that a big assumption that I need. It's related to the sales level, which makes sense, right? It makes sense to have your fixed assets, say your production capacity, your factory values, equal to, some relationship to the level of sales. So I'm going to do that. And what you see is my accounts payable. And now let's look at some long-term financing. My bank loans, I'm going to take prior levels plus change in bank loan. Let's assume no change in bank loan. Long-term debt is the prior level plus the change in debt. Common stock is the prior level plus the change in common stock. So in the first pass, we don't make any assumptions, or we just don't change any long-term financing, either bank loans, debt, common stock. And there's my payout ratio. So what we see here, if we come down to retained earnings is the prior year's level, 375, plus this year's net income times 75%. That's the percent of the net income that is not paid out as a dividend. When I look at my total income statement, I now have a first pass income statement of 129 based on that 20% sales growth. I have total assets of 1620, and I have liabilities and equity of 1467. Now you can think of the balance sheet. The assets are the value of the things that you've purchased, the value of your assets. Liabilities and equity is how they're financed, and some of it's financed by getting no interest loans through accounts payable, getting bank loans, long-term debt, issuing common stock, and then using prior year's earnings. So all of these are financing these assets. And if you look at our forecast, we have a pretty big jump in sales, 20%, which is leading to a pretty big jump in total assets, which is also growing by 20% here. So what I'm going to need, I'm going to need to finance $153 of these assets, because right now my L&E is only equal to 1467. All right, but this is the end. This is the end of our first pass of financial statements. And our goal here is to see what the first pass net income is going to look like, and then also evaluate down here how much of my how much funds are needed, external funds are needed to finance this growth. So there's my first pass. And what we could do if we wanted to close that gap, we'd move on to our second pass and we make changes to bank loans, debt, common stock, or even things like payout ratio. So in this topic, we forecasted our financial statement. We did our first pass.